Ray is 64 years old, lives in Columbus, Ohio, worked 31 years in logistics. Last year, Ray built a dividend income retirement portfolio all on his own. He watched a dozen YouTube videos, he picked the highest yielding stocks he could find, and by December, he'd collected $11,400 in dividends. Sounds like a win, right? Almost $1,000 a month in passive income. Then tax season hit, and Ray owed $3,100 he never saw coming. His Social Security got taxed at 85%, his Medicare premiums jumped. Nobody told him that where you hold your stocks matters just as much as which stocks you pick. Today, I'm going to show you every single holding in a dividend income portfolio built to generate $1,000 a month. Every ticker, every yield, every payout month, and the one account placement mistake that silently eats 20% of your income. By the end of this video, you'll have the exact blueprint, whether you're starting with $200,000, $500,000, or $1 million. And the part most people miss isn't which stocks to buy, it's which account to put them in. I'll show you exactly what I mean in a few minutes. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. The two forces fighting inside every dividend income portfolio. Before I show you the actual holdings, you need to understand the two forces at work inside every monthly dividend income portfolio. Force number one is yield. That's how much income the portfolio pays you right now. Force number two is growth. That's how fast those dividends increase every year. Most people only chase yield, and that's the most expensive mistake in dividend investing. Here's what I mean. SPYD is a popular high-yield ETF. It pays 4.3%. Sounds great, but during the COVID crash, it dropped 46%, almost half your money gone in weeks. Now look at SCHD. It yields 3.5%. Slightly less, but its dividends have grown 10.6% per year for a decade, and its worst crash was 33%. Bad, but far more survivable. Over time, the grower wins. A 2.5% yield growing at 10% a year beats a 6% yield with zero growth by about year 10. And by year 20, the grower produces nearly 3 times as much income. That's not a theory, that's math. And here's the part people forget. Inflation is running at 2.4% right now. If your dividends don't grow, your purchasing power drops almost in half over 20 years. $12,000 a year feels like $6,000 in today's dollars. That's the silent thief nobody talks about. So the smartest portfolios use both high yield for the income you need today, dividend growers to protect you from inflation for the next 20 years. Now let me clear up the biggest myth I hear. Here's the myth. You need $1 million to earn $1,000 in dividends. Here's the truth. At a 6% blended yield, you need $200,000. At 4%, you need $300,000. The real number depends on the mix, not the million. So, which holdings did I actually choose, and why did I leave some of the most popular ones out? Let me walk you through every single pick. Every holding and why it's there. I built this portfolio with 10 holdings. Every one has a specific job. Let me walk you through them. SCHD is the backbone. 3.5% yield, 6 cents in fees for every $100 invested. It screens for companies with 10 or more years of consecutive dividend payments. This is where stability starts. VYM adds breadth. 569 holdings, just 2.3% yield, but massive diversification. These two ETFs together cover hundreds of dividend-paying companies. JEPI is the monthly income engine, 8% yield paid every month. But here's what most channels won't tell you. Most of that income is taxed as ordinary income, not at the lower qualified dividend rate. That matters, and I'll show you exactly how to handle it in a moment. Realty Income, ticker O, pays monthly too.
5.5% yield. They call themselves the Monthly Dividend Company. They've paid over 600 consecutive monthly dividends. DGRO gives me dividend growth, 2.3% yield, but a 7.8% annual dividend growth rate. It screens for sustainable payout ratios. This holding fights inflation for me. VCIT is my income floor, intermediate-term corporate bonds, 4.5% yield, paid monthly. When stocks drop, this provides stability. PepsiCo, Chevron, AbbVie, and Verizon are my blue-chip anchors. Pep has raised its dividend 54 straight years, CVX 39 years, AbbVie over 52. All four pay qualified dividends, which means lower taxes. Verizon gives me the highest qualified yield at 5.6%. Here's the key question: what's missing? I left out JEPQ on purpose for the smaller portfolios. Its 11% yield is tempting, but the tax bill is brutal in a taxable account. I also skipped most individual stocks that don't have at least 20 years of dividend growth. Now you've seen every holding, but the real question is, how much money do you actually need to make this work? The answer changes completely depending on your starting point. The math at $200K, $500K, and $1 million. Let me show you how this portfolio works at 3 levels, because $1,000 a month looks very different depending on where you're starting from. At $200,000, the portfolio needs a 6.2% blended yield. That means tilting heavier into JEPI, Realty Income, and Verizon. It generates $12,325 a year. That's $1,027 a month. Every dollar comes out as cash. Linda is 63. She lives in Austin, Texas. She retired early with a small state pension. This is her portfolio. She needs every dollar right now until Social Security kicks in at 66. At $500,000, you only need a 2.5% yield to hit $12,000. But I'd target 4.4%. That generates $21,950. Take $1,000 a month as cash, reinvest the other $829 back into the portfolio. In 10 years, your annual income grows to roughly $32,000. And 75% of it comes from qualified dividends, taxed at 0 to 15%. Richard is 59. He lives in Raleigh, North Carolina. He left a tech career with $1 million portfolio and no pension. He's delaying Social Security to age 70 to maximize his benefit. His portfolio throws off nearly $3,000 a month. He takes $1,000 for living expenses and drips the rest into growth holdings inside his Roth IRA. By the time Social Security starts, his portfolio income alone could exceed $50,000 a year. Match the portfolio to the paycheck, not the other way around. So the income is there, but here's the part that costs most retirees thousands of dollars a year, and almost nobody on YouTube talks about it.
From Columbus, his mistake wasn't picking the wrong stocks. His mistake was putting them in the wrong accounts. Here's how the trap works. Dividend income feeds into something called provisional income. That's the number that decides how much of your Social Security gets taxed. For a married couple, once provisional income crosses $32,000, up to 50% of Social Security becomes taxable. Cross $44,000 and up to 85% gets taxed. Ray was collecting dividends from JEPI and Realty Income in a regular brokerage account. Those distributions are taxed as ordinary income. Worse, they pushed his provisional income over the $44,000 threshold. 85% of his Social Security suddenly became taxable too. The $12,000 in dividends triggered more than their own amount in additional taxes. His effective rate on those dividends was over 30%. There's a second trap. It's called IRMAA. If your income crosses $109,000 as a single filer, Medicare adds a surcharge of over $1,100 a year. Dividend income counts every dollar. So what's the fix? It's called asset location. Put the right holdings in the right accounts. Taxable brokerage accounts get your qualified dividend payers: SCHD, YME, PEP, CVX, AbbVie, and Verizon. These are taxed at 0 to 15%. Many retirees pay zero federal tax on qualified dividends. Traditional IRAs get your ordinary income generators: JEPI, VCIT, bond ETFs. Everything inside an IRA is ordinary income anyway, so nothing is wasted. Roth IRAs get your highest growth holdings: Realty Income, DGRO, anything you want to compound tax-free forever. No required minimum distributions, no impact on Social Security taxes or IRMAA. Ray made one change. He moved JEPI and Realty Income from his brokerage into his IRA. That single move saved him over $1,400 a year. Quick question before I show you the payout calendar. Are you building your dividend portfolio right now, or are you still in the planning stage? Drop it in the comments. I read every single one. Now that you know which account each holding belongs in, let me show you something most dividend investors never build: your monthly payout calendar and what to do next. The secret weapon is the calendar. Most people buy a handful of stocks that all pay in the same 3 months. Then they go 90 days between paychecks. That's no way to fund a retirement. In this portfolio, 5 holdings pay monthly: JEPI, Realty Income, VCIT, and if you add BND or Maine, that's income landing in your account every single month no matter what. The quarterly payers are staggered across all 3 cycles. PEP, CVX, and SCHD pay in March, June, September, and December. AbbVie and Verizon pay in February, May, August, and November. Add Coca-Cola or Altria, and you cover January, April, July, and October. Every single month has income, no gaps, no waiting. That predictable cash flow is what keeps smart retirees from panic selling when the market drops. When the market fell in 2020, dividends kept arriving every month for people who built their calendar right. One more thing, if you don't need the cash right now, reinvest it. At 5% yield with full reinvestment, a $200,000 portfolio grows to roughly $326,000 in 10 years, and the annual income jumps from $12,000 to over $16,000 without adding a single dollar of new money. That's the power of compounding dividends. Here's what I want you to take away from this. $1,000 a month in dividends is not a fantasy, it's a solvable math problem. Pick the right mix of yield and growth. Put each holding in the right account, build a payout calendar with no gaps, and let dividend growth fight inflation while you sleep. If someone you know is trying to build retirement income, share this video with them right now. It could save them a real headache and a real tax bill. Tell me in the comments, which tier are you? 200,000, 500,000, or working towards $1 million? I want to hear where you are on the journey. If you're building retirement income and want to stay ahead of changes like this, subscribe to Dividend Hustle. I cover everything that protects your income, your taxes, and your peace of mind. Next week, I'm breaking down the JEP-EQ tax trap, the hidden cost inside that 11% yield that nobody warns you about. You don't want to miss it.